Coronavirus has been declared pandemic by WHO and the repercussions are being seen across markets and economies. Let's do a three-point analysis to understand whether investors should invest in equities in these times of corrections. 1. Outlook on global growth first. Well, the OECD has cut its expectation for global growth to 2.4% from 2.9%. It has warned that it could fall as much as 1.5% as well. Goldman Sachs expects the global contraction in the first half of the year. A section of experts are already talking about a tailspin similar to the revival which was seen in 2009 after the financial crisis. Now, Nifty has contracted over 20% from record highs, and the market correction of this severe magnitude definitely presents investors with the best buying opportunities. 2. Where is the bottom though? Well, if you really understand, it is difficult to call this a bottom, but history does indicate a level where the market tends to price in most of the negatives. The valuation at the bottom so far at 15.4 times is not close to the levels of 10 times that was seen in FY9 or 10. FY9 was on the account of deep correction due to the global financial crisis. However, the current situation is due to coronavirus outbreak becoming pandemic. Now, our reluctance to assume a black swan valuation of close to 10 times forward earnings, as was seen in 2008, stems from the fact that the rally then was solely driven by FIIs. However, Indian markets today attract strong flows from domestic institutions, with the mutual funds garnering over 8,000 crore rupees of monthly SIPs. 3. Brace for the earnings downgrade then. Well, the street still largely has no handle as to how earnings are going to pan out in FY21 in the light of corona pandemic. India is already going through a severe economic slowdown, and the supply disruption coupled with the demand slowdown will further suppress the growth outlook, which was at a paltry 5.1% in the first 9 months of FY20. Now, as the corona impact gets assessed, FY21 growth forecast will also see significant downgrades. Now, the sector most at risk would be the oil and gas sector, where the refusal to cut supplies by some key players coupled with the weak growth outlook may severely impact oil prices in the near term and hence the earnings as well. Now, global slowdown impacting several businesses stand to impact the IT sector as well. Also, Indian pharmaceutical sector as well as the consumer durable sector might feel the heat of supply disruption from China. Now, minerals and metals are likely to face severe price and earnings compression before normalcy really returns to the world economy. Our stress case assessment exercise throws up a 10% earnings for the Nifty in FY21 earnings. Now, we also expect 9,000 on the Nifty, which is 15.4 times our stress case EPS for FY21, a safe level for bottom fishing. However, investors rarely catch this perfect bottom. So they should actually start gradually accumulating on the good quality businesses as the Nifty breaks 10,000. Investors should also start with the Nifty index or large companies within the top 100.